Now with the tax-free 1031 exchange, I can take that $3 million in profit, and as long as I go buy another $5 million piece of property or bigger, I don't pay any taxes.
All right. Welcome back to episode 9 of How to Invest in Commercial Real Estate. What is up?
What's up, guys?
Welcome back.
So today's a super exciting episode. We are going over how you can invest in commercial real estate, make tons of money, and not pay any taxes at the end of it.
No way.
How do you do it?
I don't know. Joel, how you do that?
Well, lucky for me, I've been able to do that a few times.
You're in the middle of one right now, aren't you?
We are in the middle of one right now. They are called a 1031 exchange. So the basis for that is it's a section in the tax code that says that if you sell a property, that as long as you take the proceeds and you go buy another property of like kind, so similar in nature, that you can forego or delay paying taxes on all of the gain that you made from the sale.
That's awesome.
Yeah, so it's not illegal, right? I mean, it's you said it was part of the Internal Revenue Services Code. You know, it's just like this little loophole that makes investing in real estate so attractive because you don't have to pay taxes. You make all this money and you don't have to pay taxes. So
I don't know of any other vehicle that allows you to do that, where you can sell, make profit, and then not pay taxes, and even indefinitely, in some cases, not pay those taxes.
Yeah, you certainly can't do that in the stock market, right? You can't. Once you sell it, you got to pay taxes on it. There's nothing else.
Now, real estate is, and we haven't done a show on real estate taxes, but there are so many tax advantages to investing in commercial real estate. And even if you're going to pay the taxes, if you've held the asset for longer than a year, you're into long-term capital gains tax, which is still way lower than a lot of the income tax brackets.
Yeah.
So right now, depending on your income bracket and other scenarios, let's say you buy a commercial real estate property for $2 million, and you fix it up and you hold it for several years, and you end up selling it for $5 million. Now, you know, that's achievable. It sounds crazy that you would be able to make $3 million, but that's doable. I've done that with some of the deals that we've done with investors. So now, let's say I just want to pay the taxes. Well, now that $3 million in gain, I'm just going to pay 20 to 25% on that money.
yeah, so you were in at this apartment complex for $3 million bucks.
$2 million bucks.
$2 million bucks. Okay, and you sold it for $5 million. So you've got this $3 million in limbo.
That's right. You got $3 million in profit. I can take the money. And I can pay long-term capital gains on that, which is either 20 or 25% right now. So, you know,
What is that, like $600,000 or $700,000?
Yeah.
Yeah, $600,000 or $700,000. But here's the thing, guys: is think about a wage earner making $3 million in a year. Almost half of that is gone in taxes because of the tax bracket. You're in the highest tax bracket. I'm not quite sure, but after several hundred thousand of income.
Yeah.
And so you're gonna, of the $3 million, you're gonna lose $1.5 million. Approximately. Okay, but with real estate and with stocks and other things that you hold for a long period of time, now we're only paying, let's just say 25%, right? So now we're only losing $750,000. So we're already way ahead. You want to make, you don't want to make wage income. You want to make long-term capital gain income.
Yeah.
That should be a goal of yours. But what's awesome about real estate is now with the tax-free 1031 exchange, I can take that $3 million in profit, and as long as I go buy another $5 million piece of property or bigger, I don't pay any taxes on that $3 million.
So what you're saying is you have to buy a property not worth the profit that you made, not the $3 million. You've got to go buy a property that's worth $5 million or more. Is that right?
Yeah. So if you sold that $5 million property, you not only need to go place that $3 million back into real estate of like kind real estate, but you've got to go buy at least $5 million worth of property.
Yeah.
And another loophole is you don't just have to replace the cash. I mean, there's other things you have to replace too.
Yeah. If you had let's say I had a $2 million mortgage at the time that I sold it, so I've got to replace that debt as well in order to complete the exchange. So let's say I take the $3 million and I'm going to buy a $5 million building. I'll put the $3 million down. I got to get another $2 million worth of debt. That satisfies the exchange. I'm in an exchange right now where we we sold for 6.25, let's say 6.25 million.
One property?
One property.
Gotcha.
And I had a $5 million mortgage at the time that I sold.
So you've got to replace $6.5 million in property value and $5 million in debt.
That's right. And so it gets a little bit tricky because we're actually buying 3 properties to complete that trade.
I was going to ask that. So you can do it with more. So you can sell one property and you don't have to just go buy one property. You can buy.
Yeah, for sure up to 3. I think even more in some cases. But us, we're buying 3 smaller properties. So 3 properties, roughly, between 2 and 3 million. We're buying 3 of those. And so and when you add up all the debt that I'm putting on those 3, it's over the 5 million, and the purchase price is over the 6.25 million. And so that satisfies the trade. So all the gain that we had, which that we had a lot of gain coming out of that because we had bought that property really cheap.
Gain is profit.
Gain is profit. And so $3-4 million worth of gain, we're alleviating all of the taxes that would be owed on that.
And so if you didn't alleviate all the gain, if you had some left over, you could just hold on to that, but you'd have to pay taxes on it. Is that right?
Yeah. So what happens if you don't spend all the $3 million? Yep. Like, let's say you bought 2 out of the 3 deals. You spent, $2 million. You replaced your $2 million worth of debt, but you've just got, an extra $500,000 in cash, let's say.
Well, okay, if you have $1 million or $500,000 and you placed, $2 million, then you're just going to typically pay capital gains on that money.
Right.
Now we get in a little bit more complicated. If you depreciate the asset while you own it, which is a more complicated discussion, you have to recapture that at 25%, which is about what capital gains is anyway.
Right.
But yeah, it's about 20 to 25% you're going to pay on the money that you didn't place. So it's still a good deal if you can alleviate half of the taxes and then pay long-term capital gains tax on the rest of it. You're still way ahead.
Okay, so here's one thing I don't understand. So you sell this property. What do you do with the money? You just put the money in your bank account, and then the next time you sell this property, it just comes out of your bank account, or is there an intermediary, or how do you handle that?
Yeah, I mean, you definitely have to use qualified intermediary, a QI, qualified intermediary. Those can be title companies, lawyers, really common.
There's people that specialize in that.
Yeah, there's people that do it. So it's really important. If you sell a property and you want to do a 1031 exchange and you want to at least try, right? Because there's no disadvantage to trying. If you go through the 1031 exchange process and don't do anything with it, you just pay the tax at the end. There's no fault for trying. So if you want to do that, you need to get it set up before closing because all of the proceeds from closing have to go to that qualified intermediary. If you touch them, if they go to your account, if you have control over them, if you have access to them, it immediately blows the whole 1031 exchange and it's all taxable.
Okay. Yeah, it can't the QI, qualified intermediary, can't be your attorney. It can't be someone that you've worked with. It needs to be kind of a third party separate from you, and they hold the funds. And then there's a couple things you got to know is. Once you close on the property you want to exchange on, you have 45 days to identify your trade property.
Okay, so once you sell.
Yep, once you close on the sale of that property, you have 45 days to identify which properties you're going to exchange those funds into.
And what do you
that's
do?
A fairly tight timeline. Yeah,
so you notify the QI that you've identified some? Is that what you do?
That's right. Submit. Okay. They'll have a form, and you'll submit, and you'll say, hey, these are the properties I've identified. You may identify more than one property or several properties just to make sure you've given yourself some options.
Yeah, right.
You know, I think the biggest thing is there's no reporting for 1031. This goes in a book. You sign an agreement with the QI. They send you a book and all of the copies of the documents at the end. And it's just, a supporter for your accountant when they file your taxes. And if you got audited, you would be required to show them that 1031. But it's not like you just go file something online.
No,
okay. And then how long do you have to close? Either after you closed on the first property or after this 45 days? What's that timeline?
You have 6 months to get the deal closed. So 45 days to identify and 180 days to close on 1, 2, 3, whatever many properties you're buying.
180 days after the 45 or from the time you closed on that first property?
I believe it's from the time you close.
From the time you close. And it's also important that you have to replace the debt at that time too, because it's totally possible to go in and buy these properties and replace the value, that $5 million value of the sale, but have not had the debt kicked in yet. Some people will close on properties in cash and have their loan come out later. The loan and the property value has to be satisfied before the 180 days, and if it's not, it's taxable.
Okay. Okay, so I don't know if you feel like we've talked about everything there, because I'm curious about what happens if you pass away and you still own this property.
Yeah, some people will be thinking, like, surely you have to pay the taxes at some point.
When do you pay the tax, Joel?
Yeah, when do you pay the tax? And the idea is you may never pay the tax.
How?
Well, one thing is in the IRS rule is you can keep exchanging properties one after another. So let's say I'm in the middle of mine now. I'm going to buy these 3 properties, and let's say I sell these properties in 5 years. I'll have even more gain, so I can choose to roll that into new properties.
Just do it all again.
Right. Okay. And so you can just keep rolling, and a lot of people do, to where they have a huge amount of taxable basis in these properties, and so they're motivated to keep doing the exchanges because the tax bill just keeps getting bigger and bigger.
Yeah. I could see you do this for years and years. You decide, okay, I'm going to cash out. Man, you cash out on 10 or 20 million, you've got a huge tax bill coming up.
Yeah, and for unsophisticated real estate investors, there may be a lot of estates or people that pass away, and they're leaving so much money that's going to be taxed. I don't know what the estate tax is exactly, but I think it's over, 11, 12 million.
Yeah, right now it is.
Yeah, you get taxed a crap ton of money when you die.
Yeah.
These 1031s, you can leave to your children, and they immediately get a step-up basis. They pay none of that tax.
And what's a step-up basis?
It means they inherit it at the market value as of your death.
Fair market value at the death.
Yeah.
Okay.
Yeah. So
if they turn around and sold it right away, they don't know taxes.
Nope.
Yeah. It's amazing.
It's beautiful.
Yeah.
And they can start depreciating it from there. They not only don't owe taxes, but they get the advantage of depreciating the asset that you left them.
Wow. Yeah, that's quite an advantage.
I'm going to ask a question because I don't know the answer. So what if you're leaving someone a property that's $25 million, and let's say the basis is, for just example, it's down to 0, and so the person that you're leaving it to after your death, they get the step up in basis at 25 million.
Yeah.
But is that then more than the 11 or 12 million of estate tax that you can pay? And so do they end up having a tax liability of, let's say in our example, 14 million?
I don't think so.
No, because it's real estate. And if you inherit real estate, you inherit that basis in the real estate.
Yeah, that's really powerful.
Yeah.
It's so powerful because, like you said, you can start buying this property right now. You're in the middle of a 1031 exchange. You're going to hold that property for years. You'll sell that and do 1031 exchanges from that. You could keep this one 1031 exchange going, and the tax deferral from this one property you just sold in 2020, and it could be 2060, and you could still have not paid the tax on this 2020 apartment sale because you just kept deferring it back into more property.
And I think this is a good time for a disclaimer that please don't take our word for it. We are not tax experts. We have effectively utilized a 1031 exchange on multiple occasions, but check with your accountant and your attorney if you're looking into this. Make sure you get the best advice available. Yeah. But just think about what you said. Okay, so you like on my current exchange where we have $3 or $4 million of profit that we're deferring tax on. So, if I was an employee, I'd lose half of that. Mm-hmm. So, and then if I was just going to pay the taxes, I'd lose a quarter of it under real estate guidelines. So now a quarter of that, let's call it $750,000, would be the tax. Well, now I don't have to pay the tax. So that $750,000 gets invested, earning 12, 15, 18% return for me. Okay. And so year after year, compounding on money that should have, in theory, gone to the government, is now not only am I keeping the money, but I'm also earning on the money. Yeah. So you're compounding that. So just think about what that does over time, having not only keeping the money, but having it work for you. It's amazing. And that's what got me excited about real estate when I started listening to all the mentors teaching me. It's not just earning money that you need to think about. It's how much of the money that you earn do you keep? And then how much can you earn on the money that you're earning in interest? So all of those factors play in, and it really makes real estate gives it a huge advantage over other types of income. Yeah. If you can make more money and not pay taxes, and then have that tax money earn more money, it just really is an avenue to grow your wealth. Yeah.
And it sounds too good to be true. Why would the IRS create this loophole? Why are they letting us do these 1031 exchanges?
Well, it's really just to motivate people to invest in businesses and real estate and properties to spur the economy, right?
Yeah. So, if you were having to pay that $750,000 tax bill, if you do a 1031 exchange, on average, you can buy $4 to $5 million worth of commercial property with that $750,000 that you didn't have to pay Uncle Sam. Mm-hmm. So they're saying, hey, I know you made a bunch of money. I know you owe taxes on it, but if you just defer that, and if you keep stimulating the economy with these purchases, if you keep buying property, we'll get the tax eventually, man. Right. Don't worry about it. You just keep doing you scale up, you buy as much property as you want, and then if you want to pay tax before you die, you go ahead. If you want to leave it to your kids, you can do that too.
Yeah.
Listening to Kiyosaki, he used to say, "Hey, the reason that the rules are in favor of the rich are because the rich wrote the rules." And so I think about that sometimes. Like some of these tax rules, they don't make a lot of sense. It doesn't make sense that Warren Buffett, pays less percentage tax than a secretary, as he's written in his book. But just because the rules aren't fair doesn't mean that people shouldn't be taking every step to take advantage of the rules, how they're written, in order to better their future, their financial situation.
Yeah. Well, I can guarantee that the government didn't write the rules in our favor. They're writing the rules in their favor. So it's just like we said, they're just trying to spur the economy so they get more taxes in the future.
Yeah. Man, a 1031 exchange is one of the most powerful tools, especially when it comes to the tax advantages of real estate. Like Joel mentioned earlier, find a qualified intermediary, find an attorney, or find a real estate professional who's successfully used a 1031 exchange. Go talk to them about it. Send us an email, comment, message us. We'll be happy to inquire and talk more about our 1031 exchange experiences. We've got several recommendations of people you can use in the Oklahoma area as well. But other than that, 1031 exchange is very important. And I can't imagine investing in commercial real estate for, 5-10 years and not having to do one. Well, you're going to have to do it. So get comfortable with it.
And, this is how to invest in commercial real estate, but it also is a show about why to invest in commercial real estate. And so hopefully we're going to give some of the how, but also the why. Yeah. Why is it that people should be doing it? Why should they care about commercial real estate instead of just working their day job, paying 30, 40%, maybe 50% of what they earn? This is a way to keep 100% of it.
Yeah.
So,
all right, guys. Well, make sure to like and subscribe so you get a notification when we upload. We upload every Tuesday and Friday. And be sure to check out the website, howtoinvestincre.com. For the downloads and access that's on Spotify, Apple Podcasts, Google Podcasts, the website, YouTube, Facebook, Instagram. We're everywhere, Brian. Anyway, check us out. Thanks for coming.
All right.